Growth versus value investing. What the heck is that? In today's Elements in Focus, Grant Soliven and I, mainly Grant, is going to break down growth versus value investing. It's not a term that's been, yeah, it is a term that's been widely used, but it hasn't been talked about probably that predominantly in the last few years, just because growth has pretty much slaughtered value investing over the last couple decades. So, Grant, welcome. We're going to talk about the investment playbook today. If you're new watching Elements in Focus for the first time, this is where me or Grant and our advisor team break down our 5 critical elements every week and give you small pieces of things to think about, hopefully sparking some interest and ideas. So let's talk about growth versus value. As I opened, these are terms we use a lot in the industry, but one has dominated the other over a last period of time. Maybe that's not even where you want to take the conversation. So I will be quiet and turn it over to you.
No, thank you, brother. And it's always good to do these. And to Aaron's point, everyone, things change, right? So today, what I want to do is really break down what is investing and what is value investing, and then go from there and enter the conversation of kind of what we see as an organization going on today and in the future. So, first and foremost, what is a growth investment? Typically, a growth investment is a basket of companies or a single company reinvesting their earnings to expand. Right? They're trying to perform well, they're trying to grow, and these companies traditionally, not always, do well when interest rates are low and there's economic optimism everywhere. So lower borrowing costs help these growth stocks balloon up, and then future cash flows become far more valuable, fueling again higher valuations. So then now we know what a growth stock is. What's a value stock? So on the other hand, right, so we have this growth machine. What is a value machine? And value stocks and value investing often represents mature, stable companies trading below their intrinsic value. They tend to be far better. I'm sorry, not far. They tend to fare better in rising rate environments, and investors will gravitate towards these companies when they're looking for predictable cash flows, dividends, etc. So, understanding what those two are is critically important when understanding how to build a portfolio. And so, rather than try to predict when growth and value will take a lead, we found that through lots of history and lots of rewritings of books and papers, investors really benefit the most from maintaining exposure to both. So each style behaves differently during different economic transitions, and both help portfolios adapt to certain situations rather than, and this is the key word, react. So when growth stocks are surging, value holdings often provide a ballast. And when value regains strength, they often will offset cooling in high growth names. So this interplay can really smooth out returns across different types of business and economic and market cycles, creating a more balanced experience. So one thing we want to be careful of as we look at these types of investing is we want to avoid a lot of the behavioral traps that Aaron, myself, and some of our other advisory team members have been talking about for years. And so, what are some of those behavioral traps that we see? And that is performance chasing. So, I've talked about earlier, you need to have a good balance of both, but oftentimes, in particular to Aaron's comment, one can sometimes outpace or lead the other. And so, we get into performance chasing, we get into greed. And so, we shift all of our gears to one side of the equation. And in the short term, it can seem like a really good logical idea. The downside is, as we stretch market growth and market volatility and market environments out over time, the investors that abandon one side for the other and start chasing that greed or diving into fear end up removing their disciplines and end up falling short of that average market return over time. So don't let emotional decisions or headlines really fuel some of that decision making. So, what then can we do, Aaron, to construct a good portfolio that's more about what is needed and what the desire is over labels? So, ultimately, returns are driven less by what the portfolio is called, growth of value, and more by how it's built. So, here's what I mean by that. Strong portfolio construction focuses on a couple of key areas: your appetite for risk, what your goals you're trying to achieve, what they look like, and essentially, what stage of finance are you in? Are we in accumulation, preservation, distribution? There's a lot of material we've created on all three of those. If you want to learn more, I recommend you going back to our sources to review all that. But once we get into those key categories, a well-designed portfolio blends all of this information, return sources, risk exposure, time horizons, what you're wanting to accomplish in your goals, and it recognizes that labels can be fluid. So many companies often evolve from growth to value over time and vice versa. So what matters most is the underlying fundamentals of what you're trying to achieve and really your risk tolerance. And don't forget this, I've talked about this in the past too, Aaron. What beats the band most often is not being able to pick and choose and trade the right section, the right growth stocks or value stocks at a certain time of the year. Rebalancing and consistent discipline is what often outperforms over time. So, investors who succeed across decades aren't the ones that are trying to guess which is going to be good for next year or the next quarter. They're the ones that stay invested periodically, they rebalance, and they have a long term approach. So, in the end, lasting success from either growth or value investing is really about staying aligned to a strategy, having mixtures of both, and not getting caught in that behavioral trap. So, would love to have more conversations with you. If you're not one of our families, but if you are, you know about our risk barometer and how our allocation team navigates a lot of that for us. But Aaron, just wanted to take a different approach to that scenario and situation than we have before in the past.
Yeah, great job, Grant. I don't have much to add. It was very well stated. Stick to a disciplined plan. Don't change course often unless a course correction is absolutely needed. That is where we find people win the most often, is sticking to a plan and staying diligent and don't doing things out of fear and panic. So if you want a review of your investments or just want a review of your overall financial picture, schedule your next steps complimentary meeting with us at the 800 number below. You can call 800-928-4001. You can go to yourlifeafterwork.com or scan that QR code. It should link to our advisors' calendars. We will get you booked, schedule an introductory call, review your situation, and make sure we can be partnered together and a right fit. Thank you so much for watching. You all have a blessed day.